Hey everybody. So for those who don't know me, I'm Madhav Rajan. I'm the Dean and I'm the George Schultz Professor of Accounting here. It's fantastic to see so many of you here for this really special day. Um, as you all know, this is our 125th anniversary as a school. And the Distinguished Speaker Series is a great tradition at Chicago Booth, right? We bring in leaders from industry, from the community, from the government to come in, speak about sort of their insights, their experience, and allow you to participate as well. And we're thrilled to have a sort of the kickoff distinguished speaker for our 125th anniversary series. One of our most famous alums, Howard Marks, co-founder of Oaktree and currently co-chair. So I'm going to say a little bit to introduce Howard. So he founded Oaktree in '95, and he's been basically responsible for the firm's investment policy and philosophy and making sure that they stick to it. Howard is a master communicator. Many of you may have seen some of the notes that he has written. He's incredibly famous for them. He communicates about products and strategies with everybody, and nowadays contributes his experience, sort of big picture thoughts about decisions relating to investments and corporate direction. So prior to Oaktree, Howard was at the TCW Group, where he led their investments in distressed securities, high yield bonds, convertibles. And before that, he was at Citicorp for 16 years. And towards the end, he was the vice president and senior portfolio manager for convertible and high yield securities. So we're just thrilled to have Howard back here today. Howard went to Penn undergrad and then, of course, went to Chicago for his MBA. So please give a warm welcome to Howard Marks. Thank you. I have a bunch of questions for Howard, but then you can also submit your questions, and I get to see them on the iPad, and I will intersperse them, right? So please feel free to go ahead and send them in. So let me just start, Howard, with you went to Penn undergrad, you went to...
Some would say Wharton.
Some would say Wharton.
I think the last president would say Wharton.
But what did you major in?
I majored in, I intended to major in accounting, but I ended up majoring in finance.
Okay. Yeah. But you also did some other studies at Penn, right?
Well, at Penn at the time, they had two very enlightened requirements. You had to have one semester of the literature of a foreign country, and you had to have a non-business minor. So the cheaters would take as their non-business minor econ, or stat, or maybe poli-sci. But I started for the foreign literature requirement. I started with Japanese literature for a reason I can't recall, and then but I was so turned on by it that I made that my minor, okay. And I took 15 credits at the graduate level in Japanese studies.
And so after that, what drove your decision to come to Chicago, and how would you sort of contrast the experiences?
Well, the immediate impetus for going to graduate school was the Vietnam War, to be perfectly honest, among friends. And, you know, I mean, in those days, 1967, which was kind of the height of the war, if you came out of school, you had a high probability of being drafted. I had my 1A rating, which meant, you know, start packing. And I didn't want to go. And you know, if you went over there, you had a non-zero probability of not coming back. So I never just debated whether to go to grad school. Interestingly, I was debating between law school and business school. I'm not one. You know, you read articles about all these hedge fund managers, and they say, you know, at 13, I invested my bar mitzvah money, you know, and that's the furthest thing from true about me. I didn't know what I wanted to do, but I picked business school because it was 2 years and law school was 3.
Maybe a little bit about what the education was like at Chicago, and any contrast, if you will, to undergrad.
Sure.
Great.
Well, you know, I think that most of what we considered the Chicago School of Thought was developed, as I understand it, between like 62 and 64. And of course, I got here in 67. So I wrote a memo, I think it was January of 14, called Getting Lucky. Because I think that I have been incredibly lucky in my life. And I recount in there a dozen ways in which I was lucky. One of which was to come here at that time. If you've read the Malcolm Gladwell book, Outliers. He talks a lot about demographic luck, right time, right place. You know, Bill Gates, he went to high school at the right time. If he had gone 10 years earlier, when they only had batch processing with the decks of punch cards, as we did when I was here, you would get one, when you programmed, you got one iteration a day. And if you were trying to debug a program, it took you the rest of your life. So that wouldn't have been worked. And if he would have gone to high school 10 years later, everybody would have known what he knew. So he got there just as distributed processing was becoming available. He sat and his dad was prominent in Washington, so he was able to sit at the University of Washington computer lab and program all day and get 100 iterations a day. That's luck. So I was lucky. I was in the first, 1, 2, 3 classes to be taught the Chicago school, and it was a huge advantage vis-a-vis the people who didn't have exposure.
And when you left Chicago, did you know at that time that you wanted to go into the high yield space?
By the way, I didn't fully answer your question.
Go for it.
What was the education? So the point is that the education at Chicago at the time was 100% theoretical and quantitative. At Wharton, since Chicago hadn't invented all of its thoughts, at Wharton, it was 100% qualitative and theoretical and pragmatic. So either one alone wouldn't have been that great. It was really the synthesis of the two. And it took a long time to synthesize the two. But my favorite course was Jim Lorry's security investments course. And the final exam, as I recall, was how do you integrate what you learned at Chicago, or in this course, with what you know about the real world? And that was a very provocative question at the time, and a very useful question, because it made you think.
Jim Lorry, by the way, set up the Center for Research in Security Prices, CRISP, so it's had a huge impact on the school sort of going forward.
But his course was derided. The nickname
That's true even today. They don't like the investments course even today. So
but his course was called Lorry Stories, because he would invite in weekly, every other week, a practitioner from the real world who would tell stories, who would relate his empirical experience. But the theoreticians derided that. Gene Fama, at the time, started every course by saying, I've never spent a day in the real world, and I never will. And at Chicago in the 60s, that was a badge of honor. But I think the school has done a little integrating of its own.
We've tried. So let's go back to when you left Chicago. Did you know what you wanted to do after you left?
No, I had no idea. I was not one of those people who has his life planned out, and I was very young. When I was deciding what job to take, coming out of here, I was 22. What did I know? Boys' brains are still maturing until 26 or 7. Mine certainly was. But so I applied for 6 different jobs in 6 different fields related to finance, 6 different industries. And I was indifferent between them, although as an interesting anecdote, I don't know if you know this, but there was one which was a little more prestigious and glamorous than the other. So I said, if I get that one, I'll take that one. And that's the one I didn't get. So 30 years later, the guy from that company who had been the recruiter did something good for the school. And so I wrote him a letter. I said, I don't know if you remember me, but I recruited with you and I didn't get the job, but congratulations on what you've done for the school. And this was in the days of letters. So I wrote that out, put it in the mailbox, and then it took weeks, literally, to get an answer. So I get a letter back, and it says, yes, I remember you. I followed your career. And if you ever want to know why you didn't get that job, give me a call. So now I don't write a letter. Now I grab the phone. I call him up, a little pleasantries, thanks a lot. Okay, why didn't I get the job? He says, because we hired the wrong guy. I said, oh, it's really sweet of you to say that. He says, no, I don't mean it like that. I mean that the recruiters voted to hire you, and the partner came in that morning hungover and called the wrong guy. and the truth is, he actually gave the job to my roommate. And this is a true story. And I'd never told the story until my roommate was the commencement speaker at Columbia Business School one year, and he told the story. So then I said, I guess it's okay for me to tell the story. But I go on in the memo about luck, and I say, if it wasn't for that little stroke of bad luck, I could have spent the next 40 years at Lehman Brothers and ended up with nothing. Because if you were a partner at Lehman Brothers, your capital at the end was worthless when it went under. So that tells you something about, they say that man plans and God laughs, right? And it just goes to show you.
And what phase then did you decide that the sort of high yield space and that's where you would make your mark?
I had a summer job at Citibank in the investment research department for equities in '68. So when I got out of Chicago in '69, that's where I went for that job, and I continued in that. And the bank and most of the banks, what we used to things like First Chicago, Citibank, Chase, and we used to call them money center banks. That was the generic category. So the money center banks were the big investors of the day. You didn't have BlackRock, Blackstone, and all these people. And they followed mostly something called Nifty 50 investing, which was investing in the 50, supposedly the 50, best and fastest growing companies in America. And they had two distinguishing factors. Number one, they were so good that it was felt nothing bad could ever happen. And they were so good that there was no such thing as a price too high. So wherever the price went, it was certainly justified by the quality. And the justification of the price was never rigorous. It was just, they're the best. So, and if you would have bought those stocks the day I got to work, which I think was like September 29th of '69, and if you held them firmly with conviction for 5 years, you lost almost all your money, more than 90%. Mainly because the PE ratio of the average Nifty 50 stock went from 80 to 8. And that's a great way to lose 90% of your money. So I was associated with that occurrence, and it was the philosophy when I got there. It wasn't my fault. But when they brought in a new chief investment officer in '78, he wanted to populate the upper positions with his own people. So he says to me, what do you want to do next? Which is a good way of knowing you don't have that job anymore. And I said, well, I'll do anything except spend the rest of my life between Merck and Lilly. I learned that at the University of Chicago, that it's not much of a pastime. And he says to me, I want you to go to the bond department, which was Siberia in those days, and I want you to start a convertible bond fund. This is early '78, so I made the change in May of '78. Interestingly, as head of research, which was his job I got when I was 29, I had 75 people working for me, a $5 million budget, when that was a lot of money, and I was a member of the bank's 5 most senior investment committees. Now I changed jobs. I become the portfolio manager for the convertible bond fund. I have nobody reporting to me. I have no budget. I have no committee memberships. And can you say I was happy as a pig in shit?
Sure.
Okay. I was ecstatic because in the head of research job, my job was to know 2 sentences on 400 companies, the epitome of superficial. In this job, all I had to do was know more than anybody else on 20 companies. And it was much more rewarding. So I think that's informative. Some people are suited for senior, I'll say, bureaucratic positions, and some are not. And it's desirable to figure out in advance what positions you aspire to. But I went to the bond department. I started I think I was managing $15 million at the beginning. That's what they allocated to my fund for converts. And then a few months later, I got the call that changed my life from the head of the bond department. And he said, there's some guy named Milken or something out in California, and he deals in something called high-yield bonds. Do you think you can figure out what that means? A client had asked for a high-yield bond fund. So I went into that. Again, Malcolm Gladwell, that was the year that the high-yield bond business was created, 77, 78. Before that period, there was no such thing as issuing a bond with a non-investment grade rating. So it had to be AAA, AA, single A, or triple B, or you couldn't issue it. By definition, a highly levered company could not issue bonds. And the big innovation of Milken and others was to say bonds should be issuable as long as, even if they're from poor quality companies, as long as the promised return is compensatory. And so we shifted from this is bad, this is good, kind of investing, to you can invest in anything as long as the return potential justifies it. So what I said at the time is that investing is not a matter of buying good things, but of buying things well. And if you don't know the difference, you're in trouble. And it's not what you buy, it's what you pay that determines whether or not you'll be successful. A certain thing bought at a high price may be very unsuccessful. A certain bought at low enough price, it could be tremendously successful. That was the essence of the thinking with high-yield bonds. These are the bonds of America's worst companies, certainly the worst public companies. But you could make money steadily and safely if they promised a fair rate of interest and you held them and you selected carefully and diversified your portfolio. So that was a major change that I benefited from.
And what drove the decision to then set up Oaktree?
Well, you're fast forwarding by 17 years, which is okay. But, you know, we were successful. Those things went well. We developed a good performance record, although interestingly, so I ran into Gene Fama like 10 years after I started managing money, and I was talking to him about our success with high-yield bonds. He says, well, send me the record. So I send him the record, and we've beaten the index by, 200 basis points a year for 10 years. He writes back, record too short. So for the empiricist, the first recourse is to say you don't have enough data. Okay, so then about like 10 years later, I sent him the record again, and now it was probably even better. And he says, because it looks like we're beating an index by a large amount, steadily. So he says, obviously, you're taking hidden risks. Because, the theory says that the main determinant of your return is your systemic risk, systematic risk. And, if you have a higher return than would be predicted, then obviously you must be taking some risks that are not obvious. So I gave up on that course of action. Question? What was it?
Just about Oaktree and what.
Oh yeah,
sort of made
okay.
you go on.
So we had a good record. We had a good reputation with clients. In 1987, I hired a guy named Bruce Karsh to work for me. And Bruce came highly recommended. He was a former attorney who had done a little bit of investing, a couple of years. But he had this idea to start a distressed debt fund. Now, if it's dangerous to buy the bonds of low-rated companies, it's radical to buy the debt of companies that are bankrupt. But the truth of the matter is that if you're in the high-yield bond business, every once in a while you buy a bond at 100 when it's issued. It deteriorates, it goes bankrupt, it falls to 10. You go on the creditors committee, you negotiate during the restructuring, and you end up getting 30. So a little light went on. It doesn't take too long. It only took a decade to say, why not skip the 100 to 10 part? Why not just do the 10 to 30 part? And that is the essence of distressed investing. And so Bruce and I brought out our first distressed debt fund in 1988, and it was enormously successful. He's a great manager, and he had great results. And private equity and leveraged buyouts really started for real in 1985 because Michael Milken would raise money for would-be buyers of companies that enabled small companies to buy big companies. Before, when low-rated debt was not issuable, only big companies could acquire small companies. But if you could borrow 95 or 96% of the purchase price, a small company or an individual could buy a big company. And that was a big change in the world. So that was created in roughly 85 was the real seminal moment for that. And by 1990 or 91, most of the iconic buyouts of the 80s were bankrupt, because the answer is you can't get through the low spots if you only have 4 or 5% equity. And they were crushed by their debt service requirements at a time when their business went off because we had a recession. So the funds that we formed and that Bruce managed in 1990 had IRRs, if you know what that is. It's the common but flawed method for measuring the performance of closed-end investment funds. 45% a year gross return, not using any leverage. That's a pretty good accomplishment. So number one, that increased our luster. But number two, when you run that kind of money, or private equity, or venture capital, or fields, this was among the categories where you got 20% of the profits. It's called the carry, carried interest, incentive fee. And so the question with our previous employer, TCW, was how to divide that. You know, if you bring in $100 million and there's a management fee of $500,000 a year, we had a deal that we got roughly, I think, roughly half of that, or a little more. But if you can take that $100 million and turn it into $200 million and have a $100 million profit and get $20 million, who gets the $20 million? So, you know, we said, you raise the money, you do the accounting, you provide the premises, you know, you're entitled to half the management fees, but what did you do to deserve half of the incentive fees? And they drew the line at 50-50, and that was a big part of it why we walked. Now, another part of it was at the other end of the spectrum from financial and qualitative was the fact that they, like Citibank, had 50 different strategies run 50 different ways. And as I rose in that company, I was uncomfortable being a mouthpiece for strategies I didn't believe in. You know, we had people who made interest rate forecasts, which I'm agnostic about. I didn't feel comfortable fronting for that strategy. We had people who, our approach has always been conservative, and I think that you build the best record in the long term by having a lot of good years and an absence of bad years. But there were people who swung for the fences every day. I was uncomfortable with that. So that was another reason why we left. But we started, you know, 5 of us left as a group, which I was later informed was illegal, since I had recruited the group, to start Oaktree April the 10th of 95. And we then we gave TCW 30 days notice. When we opened our doors, 27 more people quit and came to work with us. So we had essentially the whole group that we had at TCW, and the rest is what it is. But I'll just say that we were lucky, and again, luck. In 2000, the tech bubble burst. And you know, I mentioned that all the Nifty 50, you lost 90% of your money. In most tech stocks at that time, you lost 99% of your money. It was really a bloodbath. And the S&P was down in 2000 and 2001 and 2002. So it was the first 3-year decline for the S&P since 1939. And basically, people lost faith in the stock market. And you know, money started to migrate away from stocks. At the same time, the Fed reduced interest rates to stimulate and rescue the economy. So now you have stocks where there's no interest and bonds which pay very low returns. So most people in the institutional world concluded that they had to go to what were called, well, first they had to create a term, and the term that was created was alternative investments. And that's what Oaktree does. But we did it before there was a name for it. And that's what KKR does, Blackstone, Apollo, and Carlyle, and so forth. But in other words, now there's an onslaught of money to alternative investment categories because people conclude that they can't get the returns they need from stocks and bonds. But we were positioned well to benefit from that. So that's another example. And you can only put that down to luck.
So we had a bunch of questions that came in ahead of time, so I'll ask you one,
Yeah.
Which is about Oaktree's strategy. And so Oaktree's strategy is identifying underappreciated assets and striving to go against the herd in order to have a chance to deliver above average returns. The question is, how do you decide you're right and the herd is wrong? What methods do you have to avoid confirmation bias?
Well, first of all, I mean, that's the definition of value investing. You want to buy things for less than they're worth. Buying things for what they're really worth is not very exciting, and buying things for more than they're worth is definitely not a great idea. So value investing is all about buying things for less than they're worth. And I hasten to point out that that sounds like a reasonable way to spend your life and a reasonable goal. The challenge is that it requires assistance from somebody else who's willing to sell things for less than they're worth. And that doesn't seem such a great idea. So the answer is our funds basically do best in crises when asset holders get scared and dump assets. And if you look at, I mentioned the 1990 funds, they did great, 91 was great. Then we had to wait a decade for the 01-02 funds, which did even better. And then 7 years for the global financial crisis when we did well. And then we had this thing called the pandemic. So we have a 35-year record in distressed debt investing. On average, we've made, I think, 22% a year before fees and 16% a year after. But the returns in the non-crisis years are pedestrian, but the returns on the funds that were formed and invested during the crisis years, which was only 6 years out of the 35, pulls up the average substantially to 22 gross.
So going back to, say, 2000...
No, but the question... No, I skipped the part of the question. So you buy things that, for what you think is less than they're worth. What makes you think so?
Yeah.
And how can you be sure that your decisions are not made based on biases? Well, there will be a lot of things that you'll learn in the investment business, and there will be a lot of things that we talk about today, where I can't tell you how. There is no how. Who was it? John Kenneth Galbraith once said, "There's nothing intelligent to be learned about managing money, because if there were, study would be intense, and everybody with a positive IQ would be rich." You can't, and I had a great day on Monday. I went up to West Point and spoke to a bunch of cadets there who were interested in finance. And who would have thought it? But this guy says to me, "How do you know when to sell? What's the amount where if it's up you sell? What's the amount where if it goes down you sell to prevent further losses?" I can't tell you. Everything that you learn about making money, and certainly everything that you learn here about how to invest, it's an intellectual framework. It's what to do. Nobody can tell you how to do it. And you can try to sharpen your focus and think about things in better and worse ways. But I created a concept called second level thinking, which is thinking different from the herd, deeper, hopefully more sophisticated, but also better. If you think different but worse, you have a problem. So second level thinking, you have to think different and better. And in my first book, which is called The Most Important Thing, I have 20 chapters. Each chapter says the most important thing is, and then it's a different thing. because in investing there is no one most important thing. There are many, many things that are very important. But the first chapter says the most important thing is second level thinking. But I say in there, and people ask me all the time, can you learn to be a second level thinker? And I say, I don't know, but I'm a little cautious on the subject. And I said, it's like in basketball, they say you can't coach height. All the coaching in the world will not make your players taller. And it's true. And so there are certain requirements for being a successful investor, one of which is the ability to be a second level thinker, and another is the ability to be unemotional. Can you teach these things? And the answer is I don't know. I can explain to you why it's important, but I don't know if I can produce it in you. It all comes down in the end to insight. Do you have it or don't you have it? And I don't know if people who don't have it can be made to have it. I think because a lot of it is an art form. We see the future, and the only way to think about our whole industry is based on forecasts. I don't believe in macro forecasts. Economy, market, currency, commodity, interest rates. Unpredictable. There's a real dearth of people out there who got rich by making macro forecasts and investing on that basis. But we all have to think about the future. We all operate in the future. One of my favorite quotes is from Ian Wilson, who ran General Electric, who said, all the sophistication in the world will not get you around the fact that everything you know is about the past and all your decisions are with regard to the future. But we have to deal with the future. And I think we have to deal with the future as a probability distribution. And the question is, who can draw in his mind or her mind a probability distribution of future events which is the best predictor? And in particular, who can best look at a probability distribution of future outcomes and determine whether the expected return suggested by perhaps the central tendency is sufficient to compensate for the risks that lurk in the left-hand tail. And this is a judgment. And as I said, I can explain to you what's important, but I don't know if I can teach insight. And the best example was Lehman Brothers declared bankruptcy on September the 15th of 2008, Friday, after the close. So we were all gone. And all the big announcements are made after the close, so they won't affect trading. And then people have time to think about it, and they come in the next day and they're ready to trade based on the new information. So I come in Monday morning on the 18th, and we had a big fund that we had raised for distressed debt investing and just put on the shelf in reserve. We had 10 billion of capital, dry powder, sitting on the shelf. Should we invest it or not? Well, the concern was that the global financial system was going to melt down and that all the institutions were going to disappear. That was the thesis. So what do you do about that? Well, you analyze whether that's true. Hold it just a minute. How do you analyze whether it's going to happen? And the answer is there's no such thing as analyzing the future. We go on the data we have, we extrapolate from prior experience, and then we enter into supposition. By the way, I got that methodology from an epidemiologist at Harvard who, that's how he described his approach to the pandemic in the first week of the pandemic. And of course, what he was saying is there is no data on the pandemic. There are no historical analogies. It's all supposition, which it was. Anyway, my point is you can't analyze whether or not the world's financial system is going to melt down. It really is, ultimately, many of these things are an article of faith. But you have to do it. And my sense is that not everybody, or not everybody with a positive IQ, can do it, regardless of how much education they get.
Mm-hmm. So I want to take you to one decision which you made, which is you've written about having sold a lot of assets in 2005, 2006. What drove you to do that? What sort of backing did you, and how did that turn out?
The Financial Times of England has a column every Saturday called Lunch with the FT. And a writer takes somebody to lunch, and they talk about the lunch, and they report on the conversation. And I enjoy them, and they're very interesting because the people they talk to are varied, not just people like me. But in the fall, they took me to lunch, and I took them to my favorite Italian restaurant, and we talked about these things. And the writer says, "Can you send me some of your memos? Select a few that will give me a sense of what we want to talk about." So I went through the memos since 2020, and I pulled out 6 that I thought were written at turning points in the market. Mm-hmm. And since I was doing the selecting, they were all correct. The common thread among them is, number one, they don't include any predictions, because I don't believe in predictions. And Oaktree, when we started Oaktree in '95, we sat down, and since we had the benefit of having worked together for 9 years, my partners and I wrote down what we believed in, what was our investment philosophy. Mm. And I think it's very important to have a philosophy, I would actually say a creed or a religion. What do you believe in? What don't you believe in? What will you do? What won't you do? And a lot of that was informed by what I learned here. Mm. And there are 6 tenets. The 5th one says, our investment decisions are not driven by macro forecasts, because nobody can forecast well enough to reliably make decisions. So the memos don't contain forecasts. They don't generally contain a dissection of securities, individuals or groups or anything like that. Most of what the memos are about is investor behavior. And I was talking with Professor Minnis before we started, and we talked about the fact that the economy, if you graph it out, kind of looks like this. It's an upward sloping line. It has an innate secular growth rate underlying, and small fluctuations. So the economy grows 2% a year on average, sometimes 3, sometimes 1, sometimes maybe 4, sometimes maybe -2. But clearly, the range of outcomes is modest, so if you do it on the right scale, the fluctuations are small. Then, if you graph corporate profits, they look like this. Corporate profits fluctuate much more than the economy, even though most of the movements in corporate profits are determined by the economy. Why do they fluctuate more? And the answer is that companies have leverage. They have financial leverage, which means that a certain change in the profits of the company here, after paying off the bondholders, makes the return to the shareholders much more volatile. And they have operating leverage. Since a bunch of the costs are fixed, if the volume doubles, the profits quadruple. If the volume goes in half, the profits disappear. So companies are leveraged, and profits are much more volatile than earnings. Then if you graph the stock market, it looks like this, up and down crazily. That's what investors really care about in the short run. Why are stock prices so much more volatile than corporate profits, which, if you think about it, when you buy a stock, all you're buying is a share of corporate profits. Mm-hmm. Shouldn't they reflect the same volatility? Why should the price of a share of profits be more volatile than the profits themselves? Mm-hmm. And the answer is that Richard Feynman, the great physicist, once said that physics is easy because physics would be much harder if electrons had feelings. The market is composed of one thing, any market, people. people have feelings. So they get excited and they bid the value of a share of corporate profits very high. Then they get depressed and they price it very low. So naively, people think that the changes in stock prices are determined by corporate events, by fundamentals. And if you watch TV, the announcer says the stock market was up 200 today because Tesla had a great announcement. Or the stock market was down 200 today because it looks like inflation is raging. The proper answer is the market was up 200 because today people became more optimistic. Or it's down 200 because people became more depressed. It is psychology that determines. So what a lot of my attention in my senior status is directed at trying to figure out what's going on in the market today in terms of investor psychology and behavior. And what does that tell us about the proper behavior for ourselves? And so you knew I was going to get to your question sooner or later. So in 05 and 06, I detected optimism, excessive optimism, excessive eagerness, excessive ardor, insufficient risk aversion, insufficient fear. And consequently, that implies that asset prices are probably too high. That was it. That was it. And so I wrote a memo and I wrote a call, and it says, there they go again, talking about the fact that investors were engaging in some of the ill-founded behavior that I've seen in past crises. And it basically said, this is the time for caution. And of course, that was 05, 06, 07. The global financial crisis started to occur. 08 is when Lehman reached its bankruptcy, and the worst of the financial crisis started to occur. So, it's really, I recorded a podcast about this yesterday. It's really a matter of just extremes. The economy goes like this. Profits go like this. Stock prices should go like this. But sometimes they don't because of people's emotionality. So if you can gauge the emotionality, then you can say, I'll bet it seems too heated, seems too cold. I wrote a book called Mastering the Market Cycle, and I consulted my son, who's a very smart investor, about some of the ideas. And at one point I said to him, Andrew, I think my market call, here's a guy who doesn't believe in forecasts. I said, I believe my market calls have been correct. He says to me, yeah, Dad, that's because you did it 5 times in 50 years. Extremeness, that's the word that came out of my podcast yesterday, extremeness. 5 times in my 54 years, or maybe it was 6 or 4 or 7 or something like that. 5 times. The market was either up here, crazy high, or down there, crazy cheap. And on those occasions, the case for a call was overwhelming, in my opinion, and the probability of success was high. But if I had tried to do it 50 times in 50 years, or 500 times in 50 years, or 5,000 in 50 years, I couldn't have had a very high batting average. But 05, 06 was one of those times. I just, what I learned here, among other things, but one of the most important things I learned here is that risk aversion, it has to be a fundamental part of a market. It is risk aversion that makes people demand higher return potential from investments that appear riskier, which is, of course, the only thing that makes sense. It is, so if you think about it, it is risk aversion that keeps markets safe and sane. And if I'm in an environment where I detect that risk aversion is inadequate, that's fertile ground for excessively high prices. Sometimes, like in 08 after the Lehman bankruptcy, I can get a sense that risk aversion is excessive. And thus prices are probably too low. That's a time to become a buyer. So, as I said, we came in on September 18th with $10 billion on the shelf. Should we invest it? Well, let's analyze whether the financial system's going to melt down. No such thing. How did I make a decision? What I decided was this. It's hard to predict the end of the world. It's never happened before. And so you don't have a very good decision-making system. It's hard to do so and assert a high probability that you're right. It's hard to, if you make a prediction that the world's going to melt down, it's hard to know what to do about it. What do? How are you going to live? Are you going to walk around with a gold bar and peel off a little to buy the stuff you need? And it's hard to act on it. And most of the time, the world doesn't end. So it was very hard to reach that opinion. And I said, rather, if we invest today and the world melts down, it won't matter. The money on the shelf won't do any good anyway. But if we don't invest today and the world doesn't melt down, then we didn't do our job. So to me, it was a very easy decision. And Bruce, we hashed these things out together, but we were in agreement. So he invested for that fund I mentioned, $450 million a week on average for the next 15 weeks. $7 billion over a quarter, almost all the fund. And it turned out that the world didn't melt down. Bear Stearns had disappeared. Merrill Lynch had disappeared into the clutches of B of A. Wachovia Bank, Washington Mutual Bank, AIG, Lehman Brothers. We all knew that Morgan Stanley was next and Goldman Sachs was after that. And it looked like a downward spiral. Roughly the year you were born, no, a little earlier, there was a movie called The China Syndrome starring Jane Fonda, and it was about a nuclear reactor that gets out of control, and they're concerned that the reaction will go through the earth and come out in China, and that's the name, that's ergo the name. But you couldn't prove that it wasn't going to be true. But fortunately, I think people were so motivated by the bankruptcy of Lehman Brothers that they arrested the downward cycle, and here we are. But you can't make these decisions based on provable hypotheses. Sometimes you just have to make a judgment.
Thank you. So a question from the audience. You've spent your career studying investing around cycles. Where in the cycle do you think we are now?
Okay, good question. I get that a lot. The first thing you have to realize is that I've studied many cycles, participated, benefited in many cases. What we've gone through in the last 3 years was primarily not cyclical in the sense that I talk about. Cycles occur, everything has a trend line. So the S&P has returned 10% a year for the last century, on average. But interestingly, almost never between 8 and 12. There are very few years where the return is between 8 and 12. It's usually up 20 or up 0 or up 30 or down 10. It's kind of nutty. And that's, of course, one thing that you have to deal with data sometimes, is that, as in this case, the average is not the norm. Far from it. So why doesn't the S&P, and of course the long-term growth of the S&P is based on the long-term growth of corporate profits. Why doesn't it just go up 10% a year? Why does it almost never go up 10% a year? And the answer is that you have a 10% trend line, but some years people get really excited. And corporate management says, I think there's a boom year ahead. We want to participate in that. We want to get our share of the incremental business or more. So we're going to build another factory, hire 1,000 workers, and produce for inventory so that when the demand comes, we can supply the demand. We're going to make a lot of money. And so they go out to build a factory and so forth. But unfortunately, and so in the years when everybody's building a factory and hiring workers and building for inventory, we get gains in excess of 10% a year. The problem is that sometimes the boom year for which everybody was preparing doesn't materialize. And anyway, it turns out that everybody built a factory and produced for inventory. So there isn't much of a boom. So now they're disappointed. So we had 10% trend line, 20% year. Now we have a downward correction. We had an excess of psychology, too positive, and now we have a correction back toward the secular trend. But given the nature of psychology, the best way to think about psychology is as a pendulum. The pendulum should be in the middle. And if you say to, by the way, if you say to the University of Chicago statistics professor, pendulum swinging like this, you say to the professor, on average, where's the pendulum? What will he say? On average, it's in the middle, right? How much of its time does it spend in the middle? Almost none. Human psychology. It swings between fear and greed, optimism and pessimism, credulousness and skepticism, risk aversion and risk tolerance. But it spends rather little time at what my mother would call the happy medium. It's usually swinging toward an extreme or back. So you take that pendulum, you turn it on its side, you wiggle a little bit, you get a cycle. So most of what cycles are is periods of excess, when it appreciates more than the trend line, and then a correction toward the trend line, but it goes through the trend line to an excess on the downside, excess of pessimism. And then eventually people say, no, it's not that bad. Now it corrects back toward the trend line, but through it to a subsequent high. So I think of cycles as excesses and corrections. The events of the last 3 years were not the result of excesses and corrections on the part of the participants. We had an exogenous event, the pandemic. Mm-hmm. Like a meteor hitting the earth. Had nothing to do with cycles or the participants in the economy or the market. And then we shut down the economy voluntarily for the first time in the history of the world to fight the pandemic. That had nothing to do with a cycle. Then we had the Fed rescue the economy through stimulative monetary policy. Mm-hmm. That had nothing to do with the cycle. And so most of what's been, and then most recently, that stimulative monetary policy produced inflation. So now the Fed's raising rates to cut off the inflation. Now we're kind of getting back to normal cyclical events. So very few of the events of the last 3 years are cyclical in nature. Most of the influences were exogenous rather than endogenous. Now, however, what I've been telling people lately is that if you want to understand investor psychology, it's very simple. In the real world, things fluctuate between pretty good and not so hot. But in the minds of investors, they go from flawless to hopeless. And investor psychology swings wildly and excessively. And, of course, in March of 20, when the pandemic was raging, everybody thought the world was hopeless. By 21, when the Fed had engineered this rescue very successfully, most people thought it was flawless. And that the Fed, by keeping interest rates lower for longer, would perpetuate prosperity forever. Mm-hmm. That was too optimistic. So now we had a tough year last year. It was tough in most asset categories, and people in my business often talk about the 60-40 portfolio. It's a hypothetical portfolio. Some people actually manage money that way, mm-hmm. But 60% stocks and 40% bonds. It's old-fashioned. But it's kind of a benchmark of what you could readily do, and then the question is, can you improve upon it through active decisions? But I think last year was the worst year in history for the 60-40 portfolio because it's unusual for stocks and bonds both to do badly at the same time. So this kind of broke psychology. Now people are not feeling anymore that it's flawless. It's kind of swung down. Ironically, after the little speech I gave about the happy medium, I think we're now kind of like here. We've left flawless. We're kind of swinging toward hopeless. But in the last 6 months, it hasn't changed much. And I think we're kind of here. We're a little past the midpoint, a little bit in the direction of hopeless, but not very much. So right now, I think that psychology is moderate. I think that the prices of stocks and bonds are moderate relative to what's justified and the past. So, you know, we're not at one of the extremes that I mentioned there. Today, I don't think there's anything that smart to do.
Thank you. So we have a question that came in and also here, sort of impact of artificial intelligence, machine learning. How do you see that impacting investing strategies? Do you think it's going to bid away sort of excess returns?
I'm not going to go on about that too much. All the memos that I've written are available at oaktreecapital.com under the heading of Insights, and the price is right. They're all free. And you can read, like, there must be about 150 of them online there. You can read them all going back to the last 34 years. You can subscribe to the new ones as they come out. It's all free. So I wrote a memo, and I can say that about most things, on the subject that Madhav asked about. I think it was 2014, entitled Investing Without People. You know, because when I came here, the professor says, you know, that the average mutual fund does worse than the S&P 500, especially after fees. So why not just buy one share of every stock in the S&P 500? There was no such thing as an index fund in those days, or indexation as a process. It was 74. I was here in 68, 9. It was 74 when Jack Bogle organized the first commercial index fund at Vanguard. But now we have, in the mutual fund industry, I believe that the majority of equity capital is managed through indexation or otherwise passively by computers applying a certain theory. Why? Well, you have to remember that it's not that passive investing is so good. It's that active investing was so bad. And people, you know, get excited and they buy when things are up here and they sell when they're down there, and that applies to professionals too. But in the mutual fund world or in the professional investment world, they charge a high fee for doing so, even if they don't add value. The fees in the investment business are often not related to the value added, which is, I guess, it's a good gig if you can get it. But anyway, so now we have heavy passive investing. We have a bunch of money being run what we call algorithmically, but most of these things are taking advantage of minuscule, momentary, what I was taught to call inefficiencies, but what I would call mistakes. You know, the market makes a little mistake for a second. One thing is too high relative to another. So you act on that. It doesn't last long. It's a tiny amount of money. But if you do a lot of it and you do it on heavy leverage and you trade very actively, you know, some funds like Renaissance, for example, have a great record based on taking advantage of those momentary errors. Now, there was a hedge fund called Long-Term Capital Management, which was formed around 1977 by a bunch of very smart Nobel Prize winners, and some came from Chicago, Madhav.
Most of them did.
And they practiced what I described, taking advantage of this on heavy leverage. And they described what they did as going around the world picking up nickels and dimes. And in the fall of '98, they went bankrupt. What I said was that what they didn't recognize is they were picking up nickels and dimes in front of a steamroller. because everything was based on the fact that divergences would converge, but they went through a period when the divergences diverged, and they did it on more leverage than they could survive with, and so the lenders brought them down. But anyway, so we had index and passive, we had algorithmic, and then the last stop on the train is AI and machine learning. And so when I went here and we did rudimentary computer programming, well, I was taught that what a computer can basically do is add, subtract, compare, and remember. I don't think computers do much more than that, as I understand it. And what that means is that a computer can process a lot of data. It can do it very fast. It can do it without making any computational mistakes, and it can do it without making any emotional mistakes. That's a pretty good list. I mean, it's a limited list, but that's pretty good, and it's actually probably better than most people. And that's why active didn't work. So I would imagine that an AI-enabled or machine learning-enabled investment process will probably someday be able to outperform most investors. My own hope is that it won't be able to outperform the best investors. Because if you think about it, all of our knowledge is about the past. That's true of the computer too. All it knows is the past. And when you do machine learning, you give it all the data, all the economic data, all the corporate data, and all the price data for the last X years, and it goes through all of it very quickly, and it figures out which were the factors that gave rise to success. And then it looks for those factors in the future, and it puts them to work. That's my interpretation. Yeah. I was locked up for the first 3 months of the pandemic with my son Andrew, and one of his expressions, which caught on with me, he said that readily available quantitative information with regard to the present cannot hold the answer to get rich, right? And this is kind of the efficient market hypothesis. Everybody has this information. Back 60 years ago, 70 years ago, Buffett talks about buying dollars for 50 cents because not many people had the information. Today, everybody has the information. When I started as an analyst, every company had somebody called the analyst contact whose job it was to deal with the analysts like me from the street. But since I came from Citibank, which was a prestigious organization, what some of them did is they put the budget for the next year on the desk and went to the bathroom. And so some people got that year's budget and some people did not. And that's illegal now because the SEC passed something called Reg FD, fair dealing. And if you think about it, the goal of the SEC is to make sure that everybody has the same information at the same time. So that information can't hold the key to superiority. If you think about the efficient market hypothesis, which says that there are so many thousands of people who are intelligent, numerate, computerized, highly motivated. Can't be the answer. So in order to be a superior investor, and by the way, being a competent investor cannot be the goal. It has to be a superior investor, because only by beating the indices or the passive benchmarks can you distinguish yourself and justify a high fee. So if you want to be superior as an investor, readily available quantitative information about the present cannot hold the key. The key has to lie in either doing a superior job of intuiting the important inferences from that data, or doing a superior job of judging qualitative factors, like the quality of a company's management or the quality of its new product pipeline, or judging the future in the absence of analysis. So my question is, can a computer do those things? And I hope and think not. And the way I say it in this memo, Investing Without People, is can a computer sit down with 5 business plans from Steve Kaplan's class and figure out which one is Amazon? I think not. Can a computer sit down with 5 CEOs or their resumes and figure out which one is Steve Jobs? I think not. So I think there's still scope for individual decision making. Now, very few people can figure out which one is Amazon, and very few people can figure out which one is Steve Jobs. But hopefully, there will be scope for the best investors to add value and make a living.
Okay. Well, on that optimistic note, I will end. Please give Howard a great welcome. So thank you for everything that he's done.
Let me look at my schedule.
Go for it.
And my schedule says that I have 5 minutes. So I can take 2 questions.
All right.
Who in this audience has the best 2 questions?
Come on, don't be shy. All right, go.
Here's one.
So you mentioned those funds you raised during the crisis or before the crisis, before the best in the histories or during
Right,
the
right.
cycles. So how do you raise funds before or during the crisis?
Great question. All right. There's no other good question in the audience. This is the best question. Thank you.
Can you repeat the question?
The question is,
Yeah, thanks.
you mentioned that the funds that you raised and invested in crises did the best. So how did you know which they were going to be, and how did you deal with the other times? Is that okay?
Yeah, and then there's a follow-up question.
Oh, that's 2 questions.
I think you want to quit at the top. Just leave it.
And give me that one.
And so how do you convince your LPs?
Okay.
To give you money.
And so how do you convince the LPs to give you money for the best funds? So the answer is, first of all, you're right. It's very thorny to raise money for a closed-end fund. We have to sit here today and make a plan for how big the fund we start marketing next year and market for the year after that should be to invest in the 3 years after that. So we have to make a judgment about the investment opportunities that will be presented 1, 2, 3, 4 years from now. And we're talking about people who don't make predictions. So again, we base it on behavior. And when people are acting crazy, optimistic, we assume that they're making a lot of loans which will go bad, which will give us exceptional opportunity. And so again, it's based on empirical, but not data-driven, observations with regard to other people's behavior. And these things we've generally done these things right. The reason I can say that is that if you look at our record of these funds, 26 funds over 34 years, it's a record I'm extremely proud of because the biggest funds have been the best performers. Now that's counterintuitive because normally you would think that the smaller funds would do better because they're more agile and more adaptable and more flexible. But no, the biggest funds have been the best performers because we raised the biggest funds when we predict the biggest opportunities. And we've been right in the way I described before. And so, for example, in 2001, we raised the fund that was the best performer in this group history. The gross return was 58% a year. And how did we do it? In the summer of 2002, we had Enron meltdown and the disclosure of many scandal companies which sapped people's confidence in the business world and financial statements. Arthur Andersen went under because they had been Enron's auditor. And then we had the telecoms like Adelphia, like Nortel and Quest. And they borrowed too much money to build optical fiber at a time when it wasn't needed. So we had excessive optical fiber, and that was a big loser. So all these bonds declined in value. We bought them all at yields between 20 and 70. Yields between 20 and 70%. And then within a short time, confidence was restored. A year later, they were all yielding single digits. And that fund was up, I think, like 90% that year. Okay, put a pin in that. So if that fund was up at 90% that year, how big should the next fund be? one fund's appreciation is the next fund's declining opportunities. So the next fund should be smaller. Now, for most of Wall Street, if they raise a fund, and that fund was $1.5 billion, I think, and it's up 90% 1 year, 58% for its lifetime, how big will the next fund be? 10 billion. Why? Because they can,
Yeah.
right? And you know, there's a joke. I can't tell that joke. Is there one? Is there? There's a joke. Why does a dog do what it does? Because it can, right? I'll leave out what it does. But the point is, most people, I think the operative rule is we will not raise more money than we can. But we don't believe in that. And if we have a fund which is enormously successful and that implies diminished opportunities subsequently, then the next fund is smaller. And so the fund that I described investing post-Lehman was our Fund 7B. It was $11 billion, had very good results. The next fund, Fund 8, was $5.5 billion. We cut it in half. The next fund, 8B, was $2.75 billion. We cut it in half again. And so when we go to a client, in answer to your latter question, how do you raise money? Our clients believe us. They believe we tell the truth. We don't always say, all right, this is a great time to invest with us. This is a great time for our strategy. And because we sometimes speak against interest, they trust us. And if we say this is the time, they give us the money. And it puts us in a wonderful, privileged possibility. Because you see, when I told you the story about Lehman Brothers investing $450 million a week, there could always be a temptation to say, well, we're not, yeah, the market's way down, everything's cheap, but we think it's going to get much cheaper, so we're going to wait. And tenet 6 in Oaktree's investment philosophy is that our investments are not driven by market timing. And what that mainly means to me is we never say it's cheap today, but it'll be cheaper in 6 months, so we'll wait. We invest today if it's cheap. If it goes down, we buy more. If it goes down more, we buy more, having validated the thesis as we go. And if we run out of money, we'll get more. And the belief that we can always get more money is very freeing because it really implies, to the extent that it's true, that capital is not a scarce resource for us. And that's been the experience, and that's what's made these funds so successful. But it starts with sizing them right for the environment and then being, I would say, mature enough to resist the temptation to raise more money than you should. So I really should stop and go on to my
Thank you very much, Howard.
Thank you all.
Thank you.
I'll just say that when I came here, you can go if you want to go. But when I came here, most of us had no work experience. Like I said, I got here just after my 21st birthday. And most people did not have any context to use in integrating the theory. You do. And so the best question is Professor Laurie's question. How do you integrate what you learned at Chicago into the real world? And I hope you do a great job.